Hello and welcome to episode 481 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. A lot has happened in the last week. We've got budgets and we've got elections. How are you doing?
Yeah, a lot's still going on. So we obviously had the budget last week and we've had the US election. As we record this podcast, we're doing it slightly earlier this week. It's technically Wednesday. So we found out that Donald Trump is the new president of the US. We've still not had the Bank of England rate decision or the rate decision from the US Federal Reserve. So there's still so many moving parts. And I mention that because there might have been people listening to the podcast who probably might have been thinking we'd do a piece on how the Trump win will affect your investments, for example. But it's way too early to do that. Firstly, markets tend to react strongly in the aftermath of any event such as a US election. They did the last time Donald Trump was elected back in 2016. But also, we've got the Federal Reserve rate decision as well to still happen this week. And that will tend to move markets. And the other thing, of course, don't forget, Donald Trump doesn't actually become the president, doesn't actually take power until the new year. It's very different to the UK, where once the election takes place and the result is announced, that we effectively change government. That doesn't happen in the same way in the US. So there is going to be a period of transition. So we may look at the election and what it means for markets and if there's been a material shift. Of course, I will cover it in the market updates that I do. So I will be doing one later this month. So no doubt it will be the big talking point. But just to say, as we make the podcast, we can see the dollar has strengthened, which was something that was potentially predicted. That is on the assumption that the spending plans of Donald Trump could be inflationary as well as tax cuts. So that has pushed up the dollar. It might mean the US Federal Reserve can't cut rates as quickly as it wanted to. We'll find out more about that in the coming days and weeks. We've seen tech stocks do quite well because of the hope of deregulation. We've seen particular areas of defense do well because of potential spending on US defense. We've also seen the 10-year Treasury yield spike. Again, that's partly because of concerns over potential inflationary pressures from Trump's plans going forward. Of course, Chinese equities have lagged in the initial aftermath of the US election, and that's because of talks of tariffs going forward. So there's lots of moving parts. We're still seeing the fallout of what's happening in the US election. And of course, markets do tend to knee-jerk react. So I'm not going to go into that in any more detail than I've just said. The other thing that I wanted to mention is that we've got a review that we're going to read out on the podcast. So please, if you find the podcast in any way useful, you're a regular listener, do leave those reviews. If you listen to us via the podcast app on Apple phones, then please do leave a review. We've not had one on there for quite some time. So that would be lovely to see a review on there. We'll read it out on the podcast in the future. Of course, you can email us in or give us a thumbs up, star rating, whatever it is on the app of choice that you use, for example, Spotify. But I mean, Andy, we have got a review that's come in this week via email from Kirsty.
That's right. And Kirsty says, fab podcast, guys. I enjoy listening every Sunday at work. It's a great summary of the autumn budget recently. You're awesome at condensing the information down into bite-sized pieces so people like me can understand it without being overwhelmed. Thanks so much for all your hard work. Please feel free to read this out on the podcast, which we have now done, Kirsty. Thank you. Thanks again for all your hard work and making this subject enjoyable. And so, Kirsty, thanks ever so much for providing that wonderful feedback. We will, of course, be sending you out a Money to the Masses mug, which we will do so for anybody else who is kind enough to write a wonderful review and let us know once they've done it. So, Damien, just before we get on to what's coming up on this week's podcast, I just want to interject with one other thing. It's a bit of an update, really, to something we talked about a couple of weeks ago on the podcast. You may recall my water bills were going up and we were going through various different products that you could order for free online to help you to save water and ultimately bring your water bill down. Well, one of the things that I ordered or came in my pack of goodies, if you like, was a couple of loo strips, leaky loo strips, which you can attach to the back of your toilet to see if your loo is leaking water without you knowing. And having attached those leaky loo strips to both of my toilets, upstairs and downstairs, we actually found out that the downstairs toilet was constantly leaking. We couldn't see it, we couldn't hear it, but from those strips, it was very evident that we were losing a lot of water that was invisible and we were unable to trace that water. And so I'm super pleased. Obviously, I do the budgeting in our household. I think I've managed to find the thing that was causing our water bills to go astronomically high.
Good. So that's good news for Andy. And it just goes to show that we do actually live the things that we talk about on the podcast. Talking about the podcast, what's on this week's show? I'm going to do a piece on this show revisiting something called the winter portfolio. It's a popular piece I do every year, looking at a portfolio that's specifically designed to take advantage of a seasonal trend in UK equities in particular. So I'm going to give you an update on the winter portfolio. Then I'm going to go on to talk about a pension mirror. So this is something that's really interesting. I think everybody listening to the podcast will want to try the pensions mirror. It effectively looks at your face and tells you your estimated age and what size pension pot you probably should have. Now, there's more nuance to it because I've actually crunched some numbers around it. So I'll be telling people how much should be in their pension pot based upon their current age. And the final piece of the podcast is going to be a short piece on a very good mantra to live your life by in terms of personal finances, but also your business finances.
Okay, so let's get on with the first piece of the podcast then, Damien, the winter portfolio. Now, seasoned listeners will have heard you talk about the winter portfolio in previous years gone by, and this year's no different. You've done that again for 80/20 members where you've done a deep dive into the details, but you've provided a summary or some highlights for the podcast listeners.
Yeah, so every year I look at the winter portfolio for 80/20 investor members, and I tend to bring some of the insights to the podcast. Now, what I love about this particular piece of research, it was originally created by me in 2019 to take advantage of a particular trend that had been identified by the UK stock market almanac. And by taking advantage of that trend and producing a portfolio that should theoretically take advantage and then sticking with it over the years so it's fixed, you're actually testing your research in the real world. And when it stands up to some real life testing, that is really gives you a buzz. It really shows the robustness of what we do with 80/20 Investor. So with this piece, if you want to see the whole thing, then obviously you can take a free trial. But I'm going to go through some of the highlights. Now, just to remind people who may not have heard about the winter portfolio before on the podcast, back in 2019, when I first looked at this research idea, the UK stock market almanac had shown that if somebody had invested £100 in 1994 and they'd stayed invested continuously for the next 25 years, they would have seen their money grow to £257, and that's excluding dividends. However, if they'd only invested in the market between the 1st of November and the 30th of April each year, that £100 would be worth £341. Conversely, if they'd only invested in the summer months, then that original £100 would only be worth £69. So I decided to take that finding and apply it to UK equities, and in particular the unit trust universe. So I crunched a lot of numbers and looked at the unit trust sectors that invest in UK equities, like UK all companies and UK smaller companies. And I looked at each of the previous 10 years and looked for funds that had not only produced positive returns during the winters, but had also performed consistently. And I looked at where they were positioned in their relative sectors and looked at how that performance has stacked up from year to year, and I actually came up with a portfolio of just 5 funds, and that was called the Consistent Winter Fund Portfolio. Now, I'm not going to go into the constituents of that portfolio. If you want to find out, you can, of course, take out a free trial of 80/20 Investor. But I also created an aggressive version of that portfolio, and I loosened the criteria slightly. So I allowed funds that maybe had a poor winter out of the last 10. So maybe they weren't quite as consistent, and therefore that meant that it was a slightly more aggressive mix because they weren't as consistent from year to year. And I looked at how that portfolio therefore performed over time. So having created these 2 portfolios, each year I revisit to see how they have performed versus the FTSE 100, the FTSE 250, the FTSE 350, for example, over those winter months, and to see whether this trend is really stacking up. And so if you go back to last year's podcast, I'll put a link in the notes of this show where I covered the winter portfolio. If you look at the winter from 2022 into 2023, the winter fund portfolio, the consistent winter fund portfolio, actually outperformed the FTSE 250 by its widest margin since we created the portfolio back in 2019. So that was obviously a good result. And if you listen to last year's podcast, you'll hear me talk about some of the funds in the portfolio, how they'd actually started last winter, so 2023 going into 2024. It actually started the first few days of that period in relatively strong form, and I was actually hopeful that it would prove pretty positive for the winter portfolio this year as well. So having looked at the numbers, I can confirm that the winter portfolio, so when I say the winter portfolio, I'm talking about the consistent fund portfolio, not the aggressive version. By May this year, so the 6-month period from the 1st of November 2023 to the 1st of May 2024, the portfolio was up around 15%, which was quite an incredible result. By the end of the year period, so by the 1st of November 2024, which is just a few days ago, the portfolio was up around about 17.5%. So the summer months has obviously been in cash, so there's been a couple of percentage points increase on that 15% return up until May because the portfolio has been in cash and earning interest. Now, if you just stayed invested in the funds within that portfolio for the entirety of the last year and not gone into cash in the summer months, which is what you do with the winter portfolio, you would have ended up with a return of around about 18% because it had rallied as much as 26% coming into the summer, but the uncertainty around the UK budget started to drag on the smallest companies out there, and that started to hurt the actively managed UK smaller companies funds that sit within that winter portfolio that I created. So the performance started to fall into that budget, and so you've had a total return of 18%, which is actually still an incredible result, and most people would be happy with that. Now, how did it compare against its benchmarks? Well, it outperformed the FTSE 100, which was up around 15.63%. The FTSE 350 was 16.66%. That's the top 350 companies in the UK on the stock exchange by market cap. Interestingly, the winter portfolio did actually underperform the FTSE 250 this year. So that was up 23.25%. So that's more invested towards the sort of larger than mid-cap range of the stock market. So that wasn't hit by the uncertainty around the budget quite as much as the funds within my winter portfolio. But what I would say, if you looked at the last 2 years, the FTSE 250 was trying and failing to play catch up with the winter portfolio. And in fact, the winter portfolio over the last 2 years still outperformed the FTSE 250. In fact, if you look at it over the last 2 years, the total return for the winter portfolio that switches in and out of cash in the summer months and into those funds that I picked all those years ago, it's up 27.15% over 2 years, whereas the FTSE 100 is up at 22.75%, the FTSE 350 is up 22.4%, and the FTSE 250 is up 20.27% over that 2-year period. So if you zoom right out and look at the performance since 2009, which was the date at which I back tested the original portfolio, because obviously I did it in 2019. So going back to 2009, that 10-year period, and you look at the numbers, including right up until the 1st of November this year. So the last 4 years where we've been in the real world testing this portfolio, the winter portfolio has returned 242.91%. The FTSE 350 is up 150.78%, and the FTSE 100 is up 146.11%. So what it shows is that you can potentially take advantage of this particular phenomenon over the longer term, but there is no guarantee from year to year that you will outperform the indices such as the FTSE 250, because the winter portfolio does tend to follow the FTSE 250, but then does tend to outperform over certain periods, and particularly history shows over those summer periods when it reverts to cash. So it's something that's particularly interesting. But when you look at these statistics, so I'm not just talking about the performance numbers, we've shown over the longer term that it has outperformed by making the switch into cash and investing in particular funds. But if you look at the statistics, so I'm talking about things like alpha, beta, that actually analyze the performance and how those returns were achieved, then the winter portfolio does significantly outstrip the FTSE 100, the FTSE 250 and the FTSE 350. So alpha, which is a measure of the apparent skill that a particular manager has at picking investment winners versus its benchmark. The winter portfolio has an alpha of 5.68. So that's the annualized alpha over the extended period that are going back to 2009. And you look at the FTSE 250, it's 0.65. The FTSE 250 is 0 because that's the benchmark I've used. And the FTSE 350 is 0.47. So another interesting statistic is beta. So if a fund or portfolio has a beta of 1, what that's effectively telling you is that it moves in line with the wider market. So if its benchmark, for example, was the FTSE 250, if the FTSE 250 moves up by 5%, then it's likely your portfolio will go up by 5% if it has a beta of 1. So what you really want is a portfolio that achieves returns that is moving not necessarily in lockstep with the market. So the returns you're getting aren't a direct result of just what the market's doing. And if you look at the beta for the winter portfolio versus the other indices, then it shows that it actually has the lowest beta out of all of them when you compare, showing that the performance is actually being driven by the allocation itself, not just by the market. It's actually being driven by the decisions being made. Moving on to one or two others, the return, obviously, the annualized return is 9.7%. That is much higher than the FTSE 100, which is 7.22. The FTSE 250 was at 8.75, and the FTSE 350, which is 7.43. That is the annualized return year on year. So over that period, you can see that's why the winter portfolio significantly outperformed. But I like Sharpe ratios. So anybody who listens to the podcast knows I like a Sharpe ratio, which effectively is a measure of the excess return you're getting for the risk you're taking. And the Sharpe ratio for the winter portfolio is significantly higher than all of the others at 0.58, whereas, for example, the FTSE 250 is at 0.31. And also the volatility levels, because it's going into cash for half of the time, the volatility levels are only measured at 10.66 for the year. So the analyzed volatility is 10.66 versus 15.19 for the FTSE 100, 16.78 for the FTSE 250, and 15.08 for the FTSE 350. The upshot is that the winter portfolio has performed strongly once again. Now, anybody who listened to last year's show would have heard me mention the Fidelity UK Smaller Companies Fund. Not a recommendation in any way, shape or form. If you're interested in it, then do go and do your own research. But I talked about how well it done previously, and it has always been a member of that winter portfolio. And this year, it actually rallied 18.51% in that 6-month period from the 1st of November 2023 to the 30th of April 24. And over the whole year, it was up 18.8%. So it basically went sideways for the rest of the year. So that just shows you the performance levels. And it was quite interesting because in the podcast last year, I said, I'll be interested to see what that fund actually does, given that it got off to a good start ahead of Christmas last year. So there you go, Andy. The winter portfolio continues its impressive run. And we'll be back next year with an update to see whether it can continue that form into the future.
Okay, so let's move on to the next piece of the podcast then. And we're going to be talking about something called a pension mirror, which is a bit of marketing genius that's been the birthchild of a pension provider. Damien, you'll go into a little more detail about exactly what it is. But just to give a bit of a spoiler to some of the listeners. Now, I can't do it on screen. Damien, you're going to do something live on screen in a second. But it gave me a set of results that I was horrified with. But you were quite pleased with yours. I'll let you explain more.
So Scottish Widows has created the pension mirror. And as Andy said, I think it's a brilliant piece of marketing. And to explain what it does, you go online to the website. We'll put a link in the notes of the podcast so people can go and have a play with it themselves. But the web address is actually pensionmirror.co.uk. And when you go there, it asks if you want to use it and you allow it to use your camera. Then what the website does, it looks at you and then guesses your age, a bit of fun, and then it tells you the size of the average pension pot for somebody of the age at which it estimates that you are. So it's taken that fun concept of the things people have probably done on social media, where you have an app that guesses your age. this is doing the same thing. So it's a bit of fun, but it's actually trying to apply something to do with pensions on it. So it's incredibly engaging, and it's very clever way of getting people to engage with pensions. And this was actually put in Waterloo Station. So they had a freestanding one which people could use, which obviously attracted attention. So I have to give Scottish Widows a bit of a pat on the back for this, but I am going to, in effect, not criticise it. I'm going to show me using it, but then I'm going to tell you some of the slight drawbacks about the results it gives you, and then give you some slightly better ones. So I'm going to do this now live on the podcast, but Andy's going to take over in a second and commentate what's going on screen for those who can't see, because I have to stay still while it's trying to judge my age. So I'm just now clicking on to allow camera on the website.
So Damien's clicked on the allow camera, and for those that are going to try that at home, it will come up with pension mirror. It's asking to keep it in an area of natural light. You've got to keep still, look down the lens. It says get ready, and there, Damien, you've got the results. I'll leave it to you.
So it now claims I'm 34. I am, in fact, 46. So that is good news. So Andy, what he was referring to, we were laughing about previously, that he's same age as me pretty much, and it guessed his correct age, didn't it, Andy? So I think everybody in the office was slightly disappointed if they weren't guessed much younger than what they are.
Yeah, I do think that the lack of hair makes it quite easy for it to estimate that I'm in my mid-40s, and I'm going to put it down to that. So I was a bit gutted. Everyone was coming up at least 10 years younger, but it's okay. I'm over it now. It was a week ago that we did it.
But as Andy said, it's a bit of fun because I've done this multiple times, and I've come up with various different ages, and typically it seems to take about 10 years off. I've always been told I look younger than I am, but we've all done this, and it tends to come up with an age that's broadly somewhere near where you are. The point is that it then gives you a number that starts to engage you with the pension pot of the average person in that age. And you can vary the age. You can move it up and down to your correct age. So I'm doing this on the screen now. I can move it up and down towards different ages so I can see what the average pension pot is. So it guessed that I was 34. It therefore says that the average person has £16,233 in their pension pot. If I put up towards my correct age, which is 46, it says the average person has £68,033 in their pension. So the idea is that it's engaging you with your pension pot, but it's also therefore making you think about, well, have I got enough in there? Now, I'm going to read out, because if you don't have time to do this, you're probably still wondering what the numbers are that come out. So I've actually gone through and crunched the numbers and done it for different ages anyway. So if you're age 25, the average person apparently has £4,633. I'll actually round these numbers up so I don't have to read out every pound and pence. So if you're 30 years old, it says the average person has about £10,600. 35-year-olds, 17,000. 40-year-olds, the average 40-year-old has £38,500 in their pension. The average 45-year-old has 59,500. The average 50-year-old is 87,000. 55-year-olds on average have 146,000. 60-year-olds have 197,000, and the average 65-year-old has 224,000. So you can see there what the numbers are. You can put yourself in there somewhere and get an estimate. Now, there'll be people who look at those numbers and might think, oh, actually, that's pretty good. I've got more than the average. The issue that I have with the tool, it's a bit of fun and it gets you talking. That is a big tick. But what it does also do, assuming it gets your age right, of course, is that it gives you the average of the people in the UK. And of course, this is an average of a population that is very bad at putting money into pensions. And it's also a population that hasn't been engaged in auto-enrolment all that long. So this is taking the average of a very bad bunch, and therefore it gives you that average, and you compare yourself to that and you think, oh, well, that's good, I'm better than average. But the reality is the money that is in the average pot is still not going to be anywhere near enough to give people what would be considered an average retirement. Now, if you go back to podcast 452, we talked about the income needed for a comfortable retirement. It was based upon analysis from the Pension and Lifetime Savings Association. So it's worth going back and listening to that. And there had been a massive jump in 1 year in the amount of money that the average lifestyle in retirement would require. So you would need to have a moderate lifestyle in retirement, £31,300 a year in income. Now, you'll see where I'm going with this in a second. Now, these numbers assume that includes the UK state pension. So if you strip that out, and I've done all these numbers, you're going to end up with about £19,300 that you need to generate from your pensions when you get to state retirement age, which at the moment is 66. So your pension pot has got to be of sufficient size, we're assuming a defined contribution pensions here, to produce that extra income to give you an average lifestyle. Well, you can already tell that 224,000 is not going to be enough when it comes to retirement to produce an annual income of £19,000 a year. Now, I've told people what the average person has at various ages in their pension, but I'm going to tell them now what they should have, because it's significantly different and I think far more useful. Now, of course, it is one of those calculations. How much should you have? It depends on how much you want in retirement. It depends on how much you're putting in. It depends on your age. So it's quite a lot of moving parts. But what I've done is gone for a typical person out there. So you can use this as a bit of a finger in the air estimate of where you are in terms of pension savings. So as I've said, I went and looked at that report from the Pension and Lifetime Savings Association, and I worked off that moderate retirement income level of 31,300. As I say, taking into account the state pension, that gives you about 19,000. It's 19,300 roughly that you need to generate from your pension pot. Now, that means that by state retirement age, if you use the various calculators out there, there's a really good one on Money Helper, which I'll put a link to in the notes of this podcast. You're going to need roughly £350,000 in your pension pot by the time you're 66. So for people now who are reaching state pension age, where they get their state pension, they're going to need roughly £350,000 in there if they're going to produce that extra income to top up their pension to the levels they need in retirement to have that comfortable retirement. I'm basing this upon a single person. If you go back to that original research by the PLSA, you will see that actually if you're a couple, then the numbers are slightly different. But based on a single person, if you start to look at the numbers and start to crunch them, if you assume that you are somebody who earns the average wage in the UK, so that's 33,700, and if you assume you're auto-enrolled, so therefore you're getting 5% employee contributions and 3% employer contributions, that actually works out roughly to be about £230 a month gross you're putting into your pension because of auto-enrollment. So I'm just taking the average person here. And so what I've done is go at various ages. So I'm going from 10 years before state retirement, 20 years, 30 years and 40 years. I'm looking at what you need to have in your pension pot, assuming that you're going to keep putting that £230 a month into your pension. It's never going to change. That's another assumption. And you're never going to get a pay rise. That's another assumption. It just gives you this finger in the air idea. Now, the numbers I'm about to read out are significantly different to the ones that calculator told you the average person had. Now, these numbers are assuming that you get 5% growth every year on all your contributions and the money in your pension. It's also assuming it's net of inflation and charges. So if you want to earn more than inflation, you've got to add that on top of this 5% growth rate. And you're not taking any tax-free cash out of your pensions. So getting all that out of the way, if you are age 26, the Pension Mirror said that the average person had £5,600 in their pot. Well, I've assumed you don't have anything and you start paying £230 a month. You would actually get to your £350,000 by the time you get to state retirement age, which at the moment is 66. I know it's going up. When you're 36 and you're still paying that $230 a month gross employee and employer contributions in total, the Pension Mirror said that you should have about £22,700 in your pot. I've actually worked out you should have about £36,000 in your pot. So if you rely on the average person, they're already only got about 63% of what they should have by that age. When you get to 46, the Pension Mirror said the average person has £68,000. You should in fact have £94,000. If you get to age 56, the Pension Mirror says you should have £150,000 roughly. I'm rounding down there, but you should have £192,000. And when you get to obviously age 66, the Pension Mirror says the average person has £225,000. Well, you should, as I've already said, have £350,000 £8,000. So you can see that most people, on average, only have about 2/3 of what they need to get the retirement that they want, the comfortable retirement, when they get to age 66. Of course, they could, with their average pots, get a slightly lower retirement, one that is basically more of a minimal retirement. But what I want to point out to people is that this pension mirror, have a play of it. It's a great idea, engages you. So what it shows is most people aren't putting enough into their pension pots, but also auto-enrollment hasn't done enough yet for people who are older to build up a big enough pension pot. For younger people, pension auto-enrollment could be a very good thing. But obviously the reality is, when you're young, you're not going to be earning the average wage when you are 22. You're likely to be earning below the national average that's out there. So you're going to have to vary your contributions. But it does show that if you start investing and putting money into a pension when you're younger, you can get a much bigger pension pot. So for the people out there who are young, of course, do make sure you pump your pensions and you start saving for retirement, which you're likely to do with auto-enrollment. But obviously, if you're older, it may be time to sit down and look at what's in your pension. Don't just focus on the average, but look at what you actually need for the retirement that you want. And in that case, you might need to go and seek financial advice.
Okay, so let's finish up this podcast with a very quick piece, Damien, on a mantra that you particularly like, and you're going to put your kind of spin on it and how people can apply it to their finances.
Yeah, so it's going to be a short piece. I'm conscious of the time of this podcast, but every now and then you do come across something that's attributed to somebody they've said. And for once, it's not Warren Buffett. And you take it on board and you think, that is actually brilliant. That sums up probably a lot of what people should be doing with their money, whether it's in their personal finances or in business. Now, the person is Bill Gates. We all know who Bill Gates is. He is obviously one of the founders of Microsoft. He's one of the wealthiest men in the world. And he has been attributed as saying, save like a pessimist, invest like an optimist. But if you want to think about it in another way, you could probably reword it as be ready for problems, but work towards goals. So the idea of the save like a pessimist, invest like an optimist, I think is brilliant for personal finance and business. Now, Bill Gates famously used to have enough money effectively in the bank so that Microsoft in the early days could run without any revenue generated for 12 months. So that is the idea of save like a pessimist, but invest like an optimist. So he was building the future like an optimist in his new technology, but he was creating a buffer because of that element of pessimism. And the point is that pessimism and optimism don't have to be things that are actually disjointed. You don't have to be things that cannot coexist. So you can do both. You don't have to define yourself as a pessimist or an optimist. We like to say people are half glass full or empty, but in scenarios you can be both. And so for a personal finance perspective, I think what people want to do is that you want to save like a pessimist. That means put money into an emergency fund. So you are putting money aside. 3 to 6 months salary or expenses is a good starting point. I do like the idea of working towards 12 months, which some people might think is slightly extreme, but in extreme times like we had in the pandemic, I think that is something that came to the fore and I think people should try and move towards. And again, that kind of resonates with Bill Gates' idea. But the notion of trying to put money aside, so you are putting money aside to deal with the emergencies in life or the things that you can't predict. But even so, you can still invest like an optimist. So you could be putting money aside, the saving part, which is probably the most important part when it comes to pensions, because you've got to actually put something in it and start that process. But when it comes to investing the money within a pension, you can be an optimist. You could be investing in things like future technology. You can invest for the long term. You, of course, need to be investing in a diversified way. We're not talking about here taking excess risk and effectively gambling your pension pot away by investing on the single stocks or anything like that. We're talking about investing over the long term. And by being an optimist, say you have a portfolio of investments, it may be things like ISAs, then when there's a market crash, you're not just bailing on that. You are investing for the long term. You're staying invested. So, for example, when I was talking about the winter portfolio, that's an example of, in the short term, things don't quite work, but in the long term, that was an example of how things can pan out if you stay invested. I'm not saying you have to follow that methodology, but it's about investing for the long term. So if you only take one thing from this podcast, I think Bill Gates' quote would be probably the pick of the bunch, because you can apply that to your finances and even your own business like Bill Gates did. So moving on from emergency fund, you could have a separate fund for some of the what ifs in life. It could be for things like home repairs or whatever. You are saving for potential problems, but you are planning for future goals. You're putting money aside, whether it be investing in junior ISAs for your children or putting money into pensions for your own retirement. So do start small if you haven't already and set clear financial goals, but keep learning as you go along and adapting. But I think it's a very good mantra that if you live by that and apply it to your finances, you probably won't go too far wrong.
Okay, so that's it. We are done for this week's podcast. As we mentioned at the start of the show, we would love to hear your feedback. We would love you to rate the podcast 5 stars, of course, via your podcast app of choice. If you do get in touch with us and let us know that it was your review, we may even send you out a Money to the Masses mug. If you want to get in touch with me or Damien, it's damien@moneytothemasses.com or andy@moneytothemasses.com. Do please like and subscribe to the videos on our YouTube channel. That really helps to grow the channel there as well. And of course, you can engage with us and like-minded listeners on our Facebook group. It's facebook.com/groups/Money to the Masses. Do please engage with all of our socials. Damien's doing lots and lots of work over on TikTok and Instagram and all the usual social places. Like, subscribe and all of that. And Damien, I think that is it. We are done for this week. Until next time.
Until next time.